Good afternoon, everyone. Thank you for joining us. I've got a couple minutes till the top of the hour. We will be starting the presentation probably just shortly after 5 o'clock Central Time. If you do have any questions immediately or throughout the presentation, feel free to ask those questions in the Q&A box. We will have a set time at the end of the presentation to answer any questions that you may have. This presentation is also being recorded, so after the presentation concludes, you will be receiving a follow-up email with a link to this recorded presentation as well. Good afternoon, everyone. It is just at 5 o'clock Central Time. We're going to give it a couple more minutes, allow for some last-minute stragglers to join, and then we will get started. Like I mentioned before, this presentation will be recorded, and you will be receiving a link to that recording after this presentation concludes. And if you have any questions, go ahead and put them in the Q&A box that can be found in your toolbar, and ask them anytime throughout the presentation. We will have a Q&A section at the end of the presentation and go through any of those questions and anything else that you might have. All right, I'd say we gave everyone enough time to join. Welcome to today's presentation. So today we will be covering retirement planning for self-employed physicians part 2. 2 weeks ago we covered our part 1 of this topic. If you missed that webinar or weren't able to join, you can find that recording along with all of our previous recordings on our website, physiciantaxsolutions.com. To get started, I'd like to briefly introduce myself and my team members. My name is Marty Williams. We also have Malvika online as well as David. Mal is one of our tax managers. David, we like to call him the wizard. If you'll see on his under his name, he has many letters behind it. So he'll be going over some of our higher level tax planning and retirement planning concepts for us today. Just a brief introduction for those of you who are not familiar with Physician Tax Solutions and what we do and how we work with our clients. I briefly want to cover what we call our strategic physician system model. There's 5 key areas that we focus around whenever we work with physicians: save, protect, build, retire, and impact. Each of these components are important, and it's important for all of our clients to be strong and equally strong in all 5 of these. Today, we're going to be focusing on the save and the build component. So when we talk about save, a large focus is around tax planning and minimizing taxes to the greatest of our ability. And when we talk about build, we get into tax efficient growth and how to build wealth tax efficiently. So today's presentation is going to be a combination of both of these 2 components. If you'd like to learn more about Physician Tax Solutions, our model, and how we work with our clients, you can feel free to find our website, again, physiciantaxsolutions.com. Shoot me a message in the chat box, and I'll be sure to follow up with you. That would probably be the most efficient way. To recap our agenda today, so we're going to start with some factors to consider when we're talking about retirement plans, the importance of diversification of retirement income, and the types of retirement plans of the part 2. So part 1 was more of the simplistic examples that we gave, and for maybe lower income or lower strategies. Today, we're going to be focusing on some of the higher level concepts, higher level strategies that help round out what we like to think of as retirement planning. We'll follow all of that up with a brief Q&A session to answer any of the questions, because I'm sure with a lot of these topics, there's going to be a lot of questions. So without further ado, I'm going to turn the mic over to David, starting with our factors to consider. And David, you are muted.
How's that?
Great.
Great. Sorry about that. So over the last 30 years working with business owners and retirement plans, I've obviously had a lot of opportunity to find out how to look at a retirement plan and how to match a retirement plan to the right business or purpose or person. And what I found after 30 years is there's no single one answer to that, to what is an ideal plan. Instead, I look at it as looking through a myriad of potential factors and issues and putting a weight next to each one of them as far as how important that one factor may be. And then at the end of the day, evaluating the pros and cons of each plan based on these factors of whether they're they are consistent or support what your goals and objectives are, or they work counterproductive to that. So over the last few decades, I've come up with a list of those factors. I won't go into them in tremendous detail here. At the end of this presentation, we're going to do a couple of case studies, and then I'll share with you what what I find the most important factors are, and then weave those into what I have about 12 different plans that apply and maybe potentially accomplish all of the goals that a client has and achieves the most tax efficient path to retirement. I'll go over those 12. 6 of them are what I call the best type of plans to have, and the second 6 are what I say would be the next best plans. Again, there's maybe some off that that are not on that list that, depending on your factors or situation, may end up being better for you than others. But what I find is these 12 typically are the ones that are the most popular based on the most common factors or the most important factors. So when we move into, and matter of fact, everyone will get a copy of this presentation. So when we go through a retirement plan decision tree, we're putting a weight next to each of these factors and coming up with at least a quantitative evaluation, weighting of which factors are the most important and which plan then is the best for a particular situation. Everyone probably has their own method of doing that. We just tend to find that addresses all of the issues. So anyway, you'll get this list, and to the extent that we can help you go through that matrix or that evaluation, we'd be happy to do that, as well as go into a lot more detail about not only the plans that we talked about at our first session, which if you happen to miss that presentation, that is on our website, and feel free to click on that link and listen to that. I will make one correction. I did mention in the previous webinar that there was a due date to adopt a 401k plan or solo 401k plan that I was in error when I said October 1st. I was actually thinking of a simple plan. So a solo 401k plan actually does not have to be adopted until December 31st of the year that you want to contribute to it. So anyway, that was an error that I made in the last presentation. So if you hear that, just ignore that reference to October 1st. So when we move into this, one of the most important things to do as you're preparing for retirement, in our opinion, is to create a diversified portfolio between what is going to be tax deferred, i.e. it's going to be taxable income, what type of retirement may be subject to lower capital gain rates, which I'll talk in a second about that, and then what type of retirement plans you might be able to build up that will be tax-free. In our opinion, and what we see most of the time when somebody comes to us is they're very significantly weighted in tax deferred retirement, and they haven't been properly building up a nest egg or a bucket, if you will, of taxable investments as well as tax-free investments. The reason that's important is that we don't know what tax rates are going to be, when our clients retire. So the best we can do is hope that tax rates will go down, although it seems like in the last few years that has seemed less and less likely. But the best thing to do is to prepare as if tax rates are going to go up during retirement. If they don't, and they in fact go down, then you're not harmed by that. If they do go up and you have put all of your money in one bucket, which is the tax deferred bucket, you in effect are going to be getting a deduction back in the year that you contributed to it at a much lower rate than what you're ultimately going to have to pay when you take that money out. And mathematically speaking, that just does not make sense. That's not good tax efficient management of your investments. The reason I want to mention about capital gains income is that if you've read in the press, the two presidential or the two candidates for president have very different plans as it relates to tax changes. In the Trump camp, they are proposing further incentives and further tax breaks, although I don't know how much lower tax breaks can go without ultimately having to pay for those tax breaks, at which generation or which time in the future. If you read the Biden plan, you'll notice that he's proposing, if he's president and subject to what passes in Congress, to eliminate the long-term capital gain rate, which right now is at a staged rate all the way up to 20%, that rate will basically reflect or mirror what the ordinary income tax rate is. And his proposal for the top ordinary income tax rate for the top 1% of the taxpayers is going to go back to the 39.6% federal rate. Keep in mind that is in addition to any state income tax that you might also have to be paying. And as we've observed in many states with our clients, there's a lot of proposed tax legislation that's planned to increase tax rates, marginal income tax rates for individuals as well. So it's a kind of a double whammy. If federal income tax rates go up and state income tax rates go up, it's all the more reason why you don't want to necessarily put all of your eggs in one basket in the tax deferred bucket. As it relates to capital gain income, that's going to weigh very heavily on people's investment decisions. As far as real estate investments or the sale of their business or even a stock portfolio. So anyway, there's a lot unknown right now. It depends on who's going to get elected, and obviously who then is, if there's a majority on all sides in the House and the Senate, as well as the presidency. It's very important. I think 2020 is a very important year to potentially evaluate what type of retirement plans you're going to have for the long term, and doing the things necessary this year potentially to mitigate your tax burden long term. And some of that may be in converting to Roth IRAs. Some of it may be Roth 401ks. There's a lot of different options out there, but it's very important to at least do a deep analysis of what long-term is best for you. I put a couple of scenarios here on the right based on how somebody might be taking money out during retirement. In the example, I show $150,000 of net lifestyle income that's needed at a 35% ordinary and a 20% long-term capital gain rate. If somebody had all of their eggs in one basket in the tax deferred bucket, they would need about $192,000 to pull out of their retirement plan in order to net the $150,000 to live on. If they had a 25% of their retirement built in stock portfolio or real estate portfolio that they could pay a lower capital gains tax on, and they took 25% out of those proceeds or those assets and 75% out of tax deferred, now they only need about $181,000 out of their asset base to live on the 150 after taxes. If they could diversify and put 1/3 in the tax deferred, 1/3 in the long-term capital gain, and 1/3 in the tax-free bucket, now they only need about $167,000 to live on before tax. The importance of this is that you'll have a limited amount of resources available for retirement. If you're having to pull out $192,000 a year out of those assets versus $167,000, it doesn't take a rocket scientist to see who's going to run out of money first. So again, it's very important. The longer you have to plan for retirement, the more important is it that you have the right diversification base in place. So if we move to the next slide, what I'm going to talk about here, what I've talked about in the first presentation, and it'd be good if any of these topics or these type of plans are interesting or of interest to you to go back to listen to that presentation. But what I did here is I carved the type of retirement plans into, in general, into what the level of contribution range it generally takes for somebody to consider one of these. So in our last webinar, we talked about IRAs and HSAs, simple IRAs, 401ks. A lot of people have SEPs, and then we also talked about profit sharing plans. We talked a little bit about restricted property trusts. I'll bring that up again in today's presentation. And then today we're going to be talking about defined benefit plans, a strategy using a charitable limited partnership. And some of these these bigger ones are going to be ones where some people may not see them per se as a retirement plan, but the way we view them is they're very tax efficient ways to create wealth and that money then is available for retirement. So we put those some of those more advanced strategies on this list just so that we can at least bring them to your attention. So when we talk about retirement plans where somebody's going to have just under $100,000, what we are typically looking at, and the first one I have here on the list, Marty, if you'll turn, I think, a couple pages. So when we're looking at under $100,000, but so this is a situation where you perhaps maxed out your 401k, potentially a profit sharing plan, or if you have both of those together in maybe a solo 401k. This is where you might be looking for putting an additional amount away for retirement. I analyze each of these retirement plans like I did in the first webinar based on the different factors that are mentioned on the left margin. And then mention what each of these plans are as it relates to those factors. So a cash balance defined benefit plan works really well if you're a business owner or a physician that has 1099 income or self-employed, and you have either no employees or your employees are significantly younger than the physician. The reason for that is this is a defined benefit plan that has an actuarial calculation as to how much has to be contributed based on a client's number of years to retirement age and then what their projected income is going to be during retirement. So it's an actuarially determined calculation. And as a result of that, if you have young employees and they have a much longer runway before their retirement date, it would generally require a much smaller contribution made to and these are assuming that these are eligible employees. You would not have to, or a practice would not have to pay as much on a defined benefit plan for a younger employee. However, the older the employee gets and the higher the compensation is that they make, it's a very significant shift to how much of that contribution then goes to that older, higher paid employee. So this is a good plan if you're a 1099 independent contractor and you've got that extra cash flow that you can sock away for retirement. One of the biggest downfalls of this is it also might get you in trouble with that tax deferred bucket that we talked about, because it's also probably the biggest plan that will rapidly build that tax deferred bucket up, potentially higher than what it should be. So it is something that is a defined benefit plan is somewhat popular with a lot of clients, but I'll show you a couple of other plans that you might want to consider either in lieu of or in supplement with a defined benefit plan. So the next plan on the list is what I call a Section 412(e)(3) plan. So this is a code section under Section 412. It relates to defined benefit plans. What it does is it allows you to bump up the amount of, so it has two benefits. One is it allows you to bump up the contribution to that you can make to the defined benefit plan a little higher than a traditional cash balance defined benefit plan can. And it has a simplified administration process, which as a result of that keeps the maintenance costs of maintaining a 412(e)(3) plan lower than a traditional defined benefit plan. And defined benefit plans I have not discovered a third-party administration firm or a financial institution that has free defined benefit plans. If anyone knows of one, I'd love to hear about it. But anyway, a 412(e)(3) plan allows you to put a little bit more in a defined benefit plan. What it allows you to also do is, to the extent that you need and want life insurance, permanent life insurance, as part of your retirement portfolio, mainly because it would provide a death benefit if you fall short of being able to fully fund it before retirement and you want to provide for your family. You can also allocate up to 49% of the contribution that you make toward whole life insurance, and typically, permanent life insurance. Typically, that's going to be whole life. Not that there's anything wrong with life insurance inside of a retirement plan, but it is beneficial for some people who otherwise need life insurance and see it as part of their overall retirement, especially if they need the death benefit. So a 412(e)(3) plan is a simplified form of a defined benefit plan. It works with quite a few people who would like to have something more simple, less expensive, and also need and want to have a permanent life insurance as part of their retirement portfolio. So the next one down on the list is what I call a super 401k plan. So what this is a combination of several plans working together. But as you can see by the amounts that you can put into this, it is significantly higher than what you would probably ever see being able to put into a defined benefit plan or a 412(e)(3) plan. So what a super 401k plan has is it has a profit sharing component, it's got a 401k component, it's got a defined benefit plan component, but it also has one other feature, and that's what's called a 401h component. So what a 401h plan is, it's another subsection of Section 401, so same section that describes 401k plans, but a 401h plan is contributions on behalf of a retiree's health or medical expenses or health expenses. What it in essence operates as is a supersized health savings account. If you make a contribution into the 401h plan, it is a tax deductible contribution, just like going into a defined benefit plan or a profit sharing plan. However, when you take that money out during retirement and you spend it on medical or health care expenses, it is tax free. So it's just like a health savings account. We call that sometimes a triple threat, in that it's one of the few things out there where you can get a tax deduction going in, it's going to grow tax-free, and then you're going to get it out tax-free. If you end up in retirement not needing it for health, medical or health care, you can take it out just like a normal retirement plan distribution. It's going to be ordinary income at whatever, and you pay tax at your marginal tax rate. So it's just a way to hedge on the fact that you might need a part of your retirement account someday to be available to pay for your medical expenses, which includes the cost of a nursing home or the medical portion of a nursing home. So it can be quite helpful, especially if you are living in a fairly nice retirement village or home and need special health care. Again, the money comes out to you tax-free, so it's kind of like having a Roth IRA just for your medical expenses. However, in this case, you get to deduct it when it goes in. The amount of the contribution that you get to put in is about 33% more than what you can put in a traditional defined benefit plan. So as you can see in the table, the older you are, the more you can generally put in. And then if you wanted to, because you had a big spike in income in a particular year, you can double up in the first year. So you do that by having the first plan year end on November 30th, and then the second plan year starts December the 1st. And as a result of that, you can make two plan year contributions in one calendar year, which in essence gives you 2 times the deduction that year. So this is a good plan if you have a lot more income available that you're trying to shelter above and beyond just what you can max out in a defined benefit plan. The next plan on here, which is one that's become very popular, is what's called a restricted property trust. So these have been around for 20 some years. But why people like this is that it's another potential triple threat in that it allows a business owner or a self-employed physician or 1099 physician to put in an amount of money that's 70% deductible. And then that money that then grows tax-free, just like a Roth IRA or a health savings account. And it also comes, the withdrawals are made tax-free as well. So it is what I call a triple threat as well. It's obviously much, it allows you to put in much more than you can in a health savings account. And the distributions, or when you take it out, are not limited to spending it on healthcare related expense like an HSA or 401h plan is. If you have several other employees, whereas you might have to include them in a safe harbor 401k or a profit sharing plan or a defined benefit plan, with a restricted property trust, you can pick and choose who you want to cover or to participate in this, including all the way down to where it's just the owner or partners of a practice. A couple of downsides to it is it requires a minimum annual contribution of $50,000. So it's not a suitable plan if you don't have at least the $50,000, and you need to commit to it for at least 5 years. So it's for the next layer of retirement funding beyond the typical 401ks and IRAs. But again, it is one of our clients' more favorite strategies, just because it is tax-free on the back end. Another feature that it has is what I describe as a self-completion benefit, in that it's got a death benefit built in, that if you died prior to when you retire and start taking the money out, the death benefit pays and makes up basically for the the lack of future contributions that you would have made and provide for your family through that death benefit. So that's the restricted property trust. I'll give you an example of what that looks like here later. Or actually, I got that right now. So I thought I'd moved it later. So let's just assume we've got a 40-year-old 1099 physician, establishes a restricted property trust, short RPT for short, contributes $50,000, and in this case, since they're young, they're going to do it for 15 years. 70% of the contributions are going to be tax deductible. So total contributions over that I'm sorry, my math was wrong. I only did it over 5 years. So 15 years, it would have been $750,000, but the math on the right is wrong, but it's all relative. So basically after tax, assuming a 45% marginal bracket, relative to a $250,000 contribution, it's really only costing Dr. Smith $171,000 after tax. If Dr. Smith started at age 66 and all the way through age 85, started receiving a distribution from the RPT, he would be able to take out $102,094 tax-free for each of those 20 years. So that's a pre-tax equivalent. If you had a qualified retirement plan or a tax-deferred retirement plan, that's the equivalent of taking out $185,000. So again, it's a net of tax or tax-free of $102,000, or a lifetime distribution of $2,041,000. So putting in $750,000 over the course of 15 years would allow Dr. Smith to pull out $2,041,000 completely tax-free over that 20-year time period. Like I mentioned on the previous slide, if there's a self-completion death benefit, if Dr. Smith died before reaching age 66, it fluctuates over time anywhere from $2.4 to $4.2 million. That would fully fund that retirement benefit, whatever was left for his family. So restricted property trusts have a very stable history of earnings. In order to get that same $102,000 annual distribution through age 85, Dr. Smith would have had to have earned just over 9.2% on average every year on whatever his pre-tax investment would have been. And he wouldn't have gotten any death benefit just by investing it in a stock portfolio. So most people would be extremely happy getting a 9.2% return every year over the life of their investment. So that's one of the other reasons why restricted property trusts are very popular. It's a safe, strong earning record investment, and it protects against the downside risk of the stock market and or in the event of death. So those are the retirement plans that if you up to about $100,000, maybe more than that if you wanted to go with the Super 401k, up to about $250,000 of contribution. One of the plans that we just talked about, or that we talked about 2 weeks ago, probably would make up the mixture of what you'd be interested in. So Marty, if you'll move to the next slide, we're going to talk about some other tax planning strategies, and several of these are ones that I've incorporated personally in my retirement planning. So I generally practice what I preach, but again, these are based on over 30 years of working with other business owners and finding which ones make sense. I mentioned these from the standpoint that some people wouldn't consider these retirement plans per se, but the way they work is that they do provide income, which is what's important during retirement, and in some cases very tax efficient. The first plan that I'll mention is a Section 72 plan. I like to call this a family bank because it has an opportunity to build or to grow multi-generationally. There's a lot of stories about how wealth perpetuates through multiple generations, and generally families who, if you've heard the phrase shirt sleeves to shirt sleeves in 3 generations, which usually means that the first generation that creates the wealth, the second generation lives on that wealth, and the third generation spends the wealth, meaning that the fourth generation has to start all over again. So in a family bank concept, what it allows a family to do through a Section 702 plan is to grow wealth tax-free, allow distributions to come out tax-free, usually by loaning money to younger family members to go out and start a business, go to school, buy their first house, those type of things. But the loan generally has to be paid back, and as a result of that, it teaches financial responsibility to their family, as well as allows that wealth to continue on into future generations. So this is a plan that the contributions go in after tax, but they unless they're put into a C corporation, which then allows at least about a 16% tax break. But then, most importantly, the value of this plan then grows tax-free, and the distributions or withdrawals are tax-free. Another popular plan is what I call the Family Endowment Program. So this is a strategy that I've worked with clients for about 25 years. It's a charitable. Matter of fact, Marty, I think you pulled up the first slide that I had, not the second version, but anyway, I don't know if this file has the number 1 next to it, or .1 in the file saved, but you may have to stop sharing your screen and pull up the newest version. But anyway, just real briefly, the Family Endowment Program, or what is generally in the structure of a charitable limited partnership. This is where you might have a surplus income above the $500,000 or so mark. I also use it very frequently whenever we have a client that is selling a highly appreciated asset, whether it's a business or an investment or real estate that they may not want to do a 1031 exchange for. The way it works is this limited partnership has 2 owners. One's a general partner, which generally is a 1% owner. That's usually the client. The other partner is a limited partner who has no voting control, no say whatsoever in the matters of the partnership or limited partnership. That's usually a 99% limited partnership interest. The client then gifts the 99% interest to a donor advised fund, which they control with a public foundation. What that entitles the client to have is a charitable income tax deduction equal to the fair market value of that 99% limited partner interest. So, for example, if that limited partnership had $500,000 contributed to it, and a 99% interest was given to the donor advised fund, that might generate a charitable deduction in the neighborhood of about $450,000. If you're in a 40% tax bracket, that's going to save you about $160,000 on your tax return that year. If you can't take that big of a charitable deduction, which is limited, if it's a cash contribution to 60% of your adjusted gross income, that deduction carries over for 5 more years. So probably you'll end up using it, if not in the first year, but over the next 5 years. More importantly, if that asset was an appreciated asset that you had contributed in, and you later sold that asset for capital, that was subject to capital gains, 99% of that capital gain gets allocated on a K-1 to your donor advised fund, which is a tax exempt entity, meaning that you ended up eliminating having to pay tax on capital gain income of 99% of that gain. So it works really well with appreciated assets. Also, if you're trying to find a way to fund additional retirement income, above and beyond what you can put into your defined benefit plan or restricted property trust. So a lot of our clients really like this strategy as well. So moving on to the next one is what's called an employee stock ownership plan, which owns an S corporation. So these are typically what you might see when you have, obviously, maybe a group practice where you have several high earning physicians. They want to set up a strategy where they are able to shift income over to a management company that's set up in the form of an S corporation that happens to be owned by an employee stock ownership plan. Because those physicians generally are going to be the highest paid employees, they're also going to be the participants of the lion's share of all of the contributions that are made to the ESOP. So that money, the reason it's tax beneficial is that deduction or that payment for management fees from the practice over to the S corporation is tax deductible. And that money then is available then to use inside the ESOP, which is a tax qualified or a tax exempt trust. However, those participants want to invest that money. So again, it creates another high-end way of shifting income, tax deductible, over to a tax exempt trust that can ultimately allow that money to come out tax free in a number of different ways. If you don't take it out tax free ultimately then it goes to the beneficiaries of those participants, which then would be taxable income. So that's the ESOP S corporation. If we go to the next one, which is an enterprise risk management, sometimes these are referred to as captive insurance companies. These again are for high income or multi-physician practices where you have a significant amount of income, or surplus income, discretionary, that you want to fund, and you don't want to include other employees like you would in a qualified plan, and you want to and it's above and beyond what you want to put in a tax-deferred plan. So what I like about an enterprise risk management, it allows you to self-insure against risks in your practice or your business, allows you to pick and choose which risks you want to insure against. So for example, you wouldn't perhaps drop your malpractice policy or your general liability because those are priced very competitively out in the marketplace. However, any other type of risks that generally you wouldn't buy, but you now would consider because you're self-insuring, it basically allows you to contribute the lesser of about 10% of your gross revenues from your business, or up to $2.2 million per year. So obviously, but there's a cost benefit that I consider. Usually you want to make sure you're contributing at least about $80,000 because of the costs of keeping it compliant and creating it. If you're above the 80,000, this is definitely one that you might want to look at. The way I recommend that you do it is you capitalize that company through your Roth IRAs or 401ks. The benefit of doing it that way is that every year that you pay the insurance premium to your enterprise risk management, that's a tax deduction to your business at whatever your marginal rate is. That money then is not income to your enterprise risk management because it's being paid to an insurance an entity that's licensed to sell your main company insurance, and under the federal tax law, that's not taxable income. But yet that income now becomes eventually turns into surplus if you don't file a claim against yourself, and that surplus now can be used as capital to invest in real estate or other types of investments. Someday, when you no longer need the enterprise risk management company and you're selling your practice or getting ready to retire, you now have all this money that you've built up inside of your enterprise risk management company. If it's owned by a Roth IRA or a 401k, you can liquidate that company, and as long as that money hasn't yet come out of the Roth IRA or 401k, there's no taxable event yet. And then if you're over the age 59 and a half, you can completely liquidate that Roth IRA or 401k with all 100% of the proceeds or the investments that you built up inside of that company completely tax-free. So to me, this is the top of the pyramid and what I would call the unicorn of ultimate tax planning, which is having the ability to channel up to $2.2 million of income away tax deductible and ultimately tax-free. So those of you who are part of a practice that has a lot of profitability, or you just want to dream of having a practice like that someday, but not having to pay tax on all of your profits, this would be definitely one that you would want to put on your wish list. So just moving into the last strategy before we wind up, and this is what I call a Section 1202 corporation. So this is a C corporation in a qualified type of business that if you own this stock for 5 years or more, you can exclude up to $10 million of gain on the sale of the stock of that C corporation. So where this might help you if you're a physician is that if you have your own practice, and now a medical practice or an accounting firm or a law firm is not considered a qualified small business because it's based on the services of one or more individuals. However, what you can do is, if you have another type of company that you own, i.e. in our case, we have what we call an intellectual property company, where we license the intellectual property company of the CPA firm to that entity. That entity, as long as we own it for 5 years or more, that entity, if sold, will be the capital gain on that sale would be excluded up to $10 million. So it's another arrow in your quiver if you're set up the right way and you have the opportunity to create a qualified small business stock. It's a great way to basically create future wealth that's going to be potentially exempt from long-term capital gain. So that's the 1202 company. I noticed we have a couple of questions in, so I will address those in a few minutes as we're winding up. we're about 42 minutes after the hour. So I want to go over a couple of case studies real quick. Again, you'll get a copy of this. I'm not going to go into a lot of details other than I'm going to identify what the type of practice is or the physician has, and then what type of plans they ought that physician ought to consider looking at, and going through the litmus test of those factors to consider which ones, if any of them, are best. So Dr. Jones, in this case, a 50-year-old plastic surgeon, owns a practice. It's an S corporation. Her practice nets about $1 million a year. She pays herself about $500,000 W-2 income, and she has 2 other employees. She's interested in saving about $300,000 a year for retirement. Our recommendation would be she would look at a combination of a backdoor Roth IRA, which she would be able to do, a health savings account, a safe harbor 401k plan. Since she's over 50, she can put in the full $26,000. A profit sharing plan, which is another $44,000, and then either a cash balance defined benefit plan, or if she wants to put in potentially a greater amount, the super 401k plan, which has the 401h component to it, and then usually a restricted property trust would make sense in her situation. So that's those are the plans that I would start with if I were talking to Dr. Jones about what would be an ideal plan for her. If we look at the second case study, so this is Dr. Reed, 50-year-old orthopedic surgeon. He's a partner in a practice with 5 other partners. So this is now he's dealing with a different level of potential retirement plan because he's got a higher amount of income and other partners. And this practice has 12 employees. His share of the profits on his K1 is $1.25 million. He and his partners also own a surgery center. And both he and his partners are interested in saving about $500,000 annually. And they're also expecting a potential sale to a venture capital group in 5 to 10 years. So this is becoming more and more common with a lot of our practices where venture capital firms are now starting to knock on their doors. So in this case, to start, what I would recommend for Dr. Reed to start with is a backdoor Roth IRA, an HSA, and a restricted property trust, probably put a little bit more in. What I would also recommend for Dr. Reed's practice, which is on the next page, is for the practice, I would also consider to have a safe harbor 401k for the group. Each of the partners can participate in that, a profit sharing plan, either the cash balance defined benefit plan or a super 401k plan, like I mentioned previously. And then in this case, this would be where it would really be attractive for them to consider an enterprise risk management company owned by their Roth IRAs or IRAs. So if they wanted to sell a surgery center eventually, that surgery center they may want to make sure that qualifies as a Section 1202 corporation so that they can avoid paying tax on up to $10 million of the gain, and or using the charitable limited partnership or the family endowment program, as we call it, to exclude most, if not all, of the capital gain. So one of the other things that you always want to consider when you're looking at Roth IRAs or Roth 401ks, or in fact doing a conversion to a Roth, is you also want to make sure you use other potential tax planning strategies. There's several of them out there that we generally recommend to clients that generally will offset the tax effect of having to put money in after tax to something that's a Roth. So anyway, I generally recommend don't do a backdoor Roth, a Roth 401k, or a conversion to a Roth without at least considering if any other tax planning strategies might be available to you that you can lower your overall taxable income to offset that increase in income that you're incurring by contributing to the Roth. So that's the second case study, and let me just close by having one more case study here. This is let's see. So this is a situation. Whoops, I'm sorry. Actually, I'm sorry. I only had 2 case studies. I was looking at the second page. Okay, so that wraps up the case study. So Marty, can you, before we jump into this, I did have 2 other slides that I had on the other file that I had emailed to you. If you wouldn't mind just,
yeah, so
pulling that one up real quick.
Let me stop share. No, not stop video. Stop share.
And while Marty's doing that, let me just mention, we are moving into the time of the year where we get heavily involved with year-end tax planning for clients. If if you happen to have the, self-employment income or 1099 income or any other businesses that are generating other than W-2 income, we have a process that we start with a strategic blueprint, which Marty will talk about here in a minute. But we generally recommend that if you're interested in saving taxes this year, that we recommend that you do that, no later than October 15th. By pushing it beyond that, it just makes it very difficult for us to have the capacity to properly plan, but then more importantly, the time necessary for you to consider what all your options are and to make sure everything gets done, properly by the end of the year. We also have several upcoming webinars. We've been doing these webinars, semi-monthly webinars since I think it was July, or no, I'm sorry, since May. We've archived and saved all of our webinars on our website, www.physiciantaxsolutions.com, if you'd like to look at any of those. And then also here in a few slides, we'll show you what our upcoming webinars are as well. So bottom line, comes down to which retirement plan might be best for you. So I've identified here 8 factors out of the 15 that I think are generally the ones that most people consider that are important. The first one is what your current marginal rate is that you're paying income tax on. But as importantly, what you think your income tax bracket is going to be during retirement. If you're like most people think that their income tax rate, if they continue to save and have enough to be comfortable during retirement, that they anticipate that their income tax rates are probably going to increase from where they are today. Third important criteria is knowing what your cash flow is, that you can contribute, because different plans allow you to contribute different amounts, and some have minimums. How much flexibility you have in the plan, so how many features can you add to that plan to customize to what you want. And then another important factor is the number of investment choices you have. So if you're picking a plan and you want the most number of investment choices, make sure you're adopting not only the plan, but also choosing where you want to put those investments in the best way or the most flexible way. Setup costs and ongoing costs is a factor. Usually the more you can contribute above and beyond the simple plans and the IRAs, or the solo 401k, usually there's going to be some kind of a setup cost or an ongoing cost. So you want to make sure you know what those are going into it. Whether the contributions are pre-tax or after-tax, obviously that's very important as it relates to your current tax return. But then I'd say the next most important is whether those distributions are going to be taxable or tax-free. Again, just making sure that you have that diversification that you need going in. So Marty, if you'll go to the next slide after this, I have here my what I call my 12 favorite retirement plans. This is solely my opinion. May not be shared by other people, but I have at the top what I call the triple threats. These are what I think are the best ones to start with. Those allow you to put money in tax deductible, tax-free growth, and the money comes out tax-free. So under $25,000 is a health savings account. That obviously wouldn't take the full $25,000. If you have $75,000, I would probably match that with a restricted property trust. If you want to move on all the way up to $200,000 of potential contributions, I would look seriously at adding a 401k plan. The only issue there is you got to have it also adopted along with a DB plan. If you have over $200,000 of cash flow, my favorite is the Enterprise Risk Management Company owned by Roth IRAs or 401ks. And then if you're above the $500,000, then I would recommend looking at the Family Endowment Program and or the S Corporation ESOP. The next best ones, which sometimes these are the only ones that make sense or that are affordable, is if you're under $25,000 and you're just getting started, the backdoor Roth IRA and or Roth 401k may make sense. If you're up to $75,000, I'd consider the Mega Roth 401k, which we talked about 2 weeks ago, and or the Section 7702 / Family Bank. Since this money is going in after tax, I would just make sure that you're looking at every possible tax planning strategy that would help you offset that in the year that you're going to contribute to those. Over the $500,000 mark, then we're looking at the cash balance defined benefit plan, and above that $500,000, then we're looking at the super 401k plan. And I think that was the one at the is that the one at the bottom, Marty?
Yes, the Super 401k.
Okay, good. Okay, so that's an order. I like the triple threats, obviously, because they're tax free. It takes off the radar screen what your tax rates are going to be when you retire. You could be indifferent or care less about that, other than other reasons to be concerned about taxes. But if you can put a triple threat into your retirement plan, that's going to get you pretty far down the road of building tax-free retirement. And then if we go to the next slide, and then we'll be wrapping this up, and I'll be answering these questions that are here.
I don't believe there is a next slide, David.
Oh, are you sure?
Yes.
Okay, so if you'll, sorry, I apologize for this, but if you'll pull up your other presentation that has the schedule for the upcoming seminars, I'll just briefly highlight them. Here in about 2 weeks, we're going to be doing a webinar on getting the most out of your qualified business income tax deduction. If you're not familiar with that, that's a new deduction that was created in 2018 that allows you to deduct 20% of your net business income. However, if you're a medical or a physician and or somebody who's in a professional service business, that deduction phases out all the way after you make $400,000 of business income. So that's coming up here in a couple of weeks. We're going to do our year-end tax planning webinar a little earlier this year on October 29th. Again, it takes several weeks, if not months, to get everything, in our opinion, in place and to vet everything. So this would be really kind of after the fact of what we would recommend most people consider year-end tax planning. But we're still going to offer this webinar to give people any ideas that they might still be able to consider. On November 10th, we're going to do tax strategies for multi-physician practices. There's a lot of things kind of like what we talked about today that a multi-physician practice can take advantage of that sometimes a solo practitioner can't. And then on November 19th, we're going to talk about how to create tax-free retirement. This is something that I have a personal interest in and passionate about, but we'll be talking about the various ways of creating a completely tax-free retirement income. On the 8th of December, we'll talk about how to reduce audit risk. We're very strategic in when we do tax planning to make sure that we're not increasing the risk of an audit. And then on the last webinar of the year, December 17th, we're going to be talking about asset protection for physicians. So this is also generally a hot topic that we have our clients ask us about. So moving to the next slide, I think we're moving to then the Q&A section. Or actually, I'm sorry, Marty, you want to talk about the process?
Yes, so we are near Q&A. Just as a brief recap of our process. So I hit on the model at the beginning of the presentation. This is our process. We start with something called a strategic blueprint. And what we do in that strategic blueprint is we look at your specific needs and situation and develop a set of recommendations based off of that needs assessment, along with the tax projection that shows you what those recommendations would do for you at your individual tax level. From there, we move to an onboarding period where we get you into our systems, introduce you to the rest of the team. We begin an implementation period where we begin implementing the recommendations we made. And then we have a quarterly pulse, which is pretty unique for a CPA firm. And one of the important and powerful factors for tax planning is acting proactively and meeting with clients on a regular basis. So we can move to the Q&A now. Real quick.
And I'll answer these. These are just two questions, kind of the same. But Marty, real quick, and just for those listening, we normally would have a 30-minute phone call to schedule an initial consultation. Because we're getting close to the end of the year, a lot of clients are interested in just jumping right into doing the strategic blueprint. Like Marty said, it's $995. It comes with a 5 times guarantee that if we can't save at least 5 times that amount of money in taxes in the first year, the fee is refunded. So it's pretty much a no-risk proposition, but it allows us to showcase what our recommendations would be based on your situation. But Marty, if you want to put in the chat box the website or the link either schedule a call or to an email of the strategic blueprint.
So I put two links in the chat box. The first one is a link directly to my calendar to schedule a 45-minute introductory call to talk about what we've talked about today and any other tax planning or questions that you might have. The second link is a link to download our starter kit. So that's the engagement letter that allows us to move forward with the blueprint. Like David said, we're beginning to come up on the end of the year. So the quicker we can get started on the blueprint, the quicker we can begin implementation and provide some tax savings for 2020.
Yeah, so we just want to give you the choice if you'd like to have the call, which normally we would recommend if we had plenty of time to get things done. Feel free to do that, but if you'd like to jump right into the blueprint, which I think after the call almost everybody does, you can just skip that call step, and then we'll make up for it when we present the recommendations. So as far as the questions, there's one is in all the plans is the contribution multiple owners put in the bucket, but adjusted to the percent each member has contributed at the end of the year. It depends on the plan. So a lot of these retirement plans that have multiple owners are going to be based on what the W-2 compensation is of each owner. If it's a defined benefit plan, it also depends on the age that partner or owner is. So some plans, it's a fixed amount. Other plans, it's a percentage of W-2 compensation. And then like in the case of the defined benefit plan, it's also based on the date of birth of the owner. And as far as whether the other question was, are these funds in these plans managed by a third party or can they be self-directed? I'm not aware of any plan that we talked about today or 2 weeks ago that cannot be self-directed. So self-directed means a couple of different things. One is, can you, for example, decide on which investments or stock portfolio you might want, with any given financial institution. So for example, if it's Vanguard or Fidelity, and you've got a retirement plan with them, you generally have to stay with that financial institution and choose among their investments. If you go another route, which is being self-directed in another sense, which is if your retirement plan can set up, for example, a limited liability company, which is owned by your retirement plan, then can you self-direct that into other types of investments, such as real estate or precious metals or those type of things? The answer is yes. There's generally just additional rules that you want to be careful of around self-dealing and making sure that you don't have an inappropriate asset inside of that LLC, because you don't have the benefit of a financial institution or another custodian overseeing that, and you may not know, unless you have good guidance on whether or not you are handling that self-directed investment properly. But yes, you can, for the most part, in all of these investments, find a self-directed custodian or administrator that can allow you to pick and choose what you want to invest in. It does not have to be. I'm not aware of any plan where you are required absolutely to have the assets managed by a third party. So hopefully that answer satisfies that question. If not, feel free to reach when we set up the call, the 30-minute call. We can talk more about that as well. So Marty, do you want to wrap it up?
Sure. Looks like there's no other questions. Again, if there are any other questions, we can facilitate those conversations outside of this call. So my last slide is just a quick thank you for sticking with this presentation all the way through the end. I know different types of retirement plans might not be the most interesting for some people, but I do think that this is very useful and powerful information for a physician to be considering. Another thank you to you, the physician community, and the time that we're in for the year 2020. So thank you for what you do. Thank you for attending this call, and look forward to speaking with each of you in the future. For another 2 weeks, we'll see you guys later.
Thanks, everyone.